Have you ever looked at your bank account and felt safe? Maybe you have $50,000, maybe $100,000, maybe even more. Every morning you open your banking app and the number hasn't changed. No market crashes, no terrifying headlines, no volatility. It feels like you're making the responsible financial decision. But what if I told you that this feeling of safety could be one of the most expensive financial mistakes you'll ever make? Because while your cash appears perfectly still, something else is moving. Inflation, time, opportunity. And together, they're quietly taking money from you every single day, without ever showing up as a withdrawal. The biggest danger isn't losing money in the stock market, it's losing wealth while believing you haven't lost anything at all. I'm Gavin, and today we're uncovering one of the most expensive financial mistakes that millions of people make without ever realizing it. Why cash feels so safe. Imagine two people. The first invests most of their savings in the stock market. The second keeps nearly everything in a bank account. Then the market suddenly crashes. The investor watches their portfolio fall. The person holding cash checks their banking app, and the balance hasn't changed at all. Who feels safer? For most people, the answer is obvious, and that's exactly why so many people end up holding too much cash, because cash doesn't just protect money, it protects our emotions. According to the research, cash feels safe because the number never changes. It gives us certainty, control, and immediate peace of mind, even if its real value is quietly shrinking over time. Emotional safety, however, is not the same as financial safety. Behavioral finance helps explain why. After markets fall, loss aversion makes us fear another loss more than we value future gains. Recency bias convinces us that the latest crash is likely to happen again. And present bias pushes us toward the comfort of holding cash today, instead of thinking about what our money could become years from now. J.P. Morgan describes cash as the most tangible and emotionally connected form of money, because we can see it, access it, and control it instantly. Holding cash gives us the feeling that we're making the safest possible decision. But here's the problem. Your bank balance may stay exactly the same for years, while your wealth quietly moves in the opposite direction. Because money doesn't lose its value all at once. It disappears little by little, day after day, through a force so ordinary that most people barely notice it. Inflation. The silent tax on your money. Now imagine placing $100 in a drawer today. You lock it away, you never touch it. 10 years later, you open that drawer expecting to have the same spending power. After all, it's still $100. But here's the reality. The number hasn't changed, yet what it can actually buy has. This is the first hidden cost of holding too much cash: inflation. Unlike a stock market crash, inflation doesn't happen overnight. It doesn't make headlines every morning. It doesn't send alerts to your phone. Instead, it quietly reduces your purchasing power year after year. Economists often call this the inflation tax because, just like a tax, it slowly takes away the value of your money without you ever seeing a deduction. The research gives a simple example. If inflation averages around 3% per year, then $100 today will have the purchasing power of only about $74 after 10 years. Your bank statement still says $100, but your money buys far less than it used to. And this isn't just a theoretical problem. History has shown how devastating inflation can become. During the late 1970s, U.S. inflation accelerated dramatically, peaking above 14% in 1980. More recently, inflation climbed above 9% in 2022, reminding millions of Americans that cash isn't immune to risk. It simply faces a different kind of risk. That's what makes cash so deceptive. When your investments lose value, the loss is obvious. But when inflation erodes your purchasing power, the damage happens quietly. No red numbers, no panic. Just a slow decline that most people never notice. But inflation is only half the story. Because while your cash is slowly losing value, it's also missing the chance to grow. And over decades, that missed growth can become far more expensive than inflation itself. That's where the second hidden cost begins. Opportunity cost. The money you never see disappear. If inflation is the first hidden cost of holding cash, then opportunity cost is the second, and for most people, it's the more expensive one. Opportunity cost isn't the money you lose. It's the wealth you never had the chance to build. Every dollar sitting in cash is a dollar that isn't invested. It isn't owning businesses. It isn't benefiting from economic growth, and it isn't compounding over time. The research highlights just how dramatic this difference can become. J.P. Morgan compared what happened to $100,000 over the 20 years from 2003 to 2023. If that money had been invested in the S&P 500, it would have grown to about $309,000 after adjusting for inflation. But if that same $100,000 had simply stayed in cash, its purchasing power would have fallen to only about $64,000. That's a difference of roughly $245,000 in potential real wealth. Not because someone made a terrible investment, but because they made no investment at all. This is what makes holding too much cash so dangerous. The cost isn't visible, no money leaves your account. Instead, your future wealth quietly disappears before it ever has the chance to exist. And there's another reason this gap becomes so large. Compounding. Every year's return earns returns of its own. The longer your money stays invested, the harder it works. The longer it stays in cash, the more opportunities it misses. The research illustrates this with a simple comparison. With approximately 3% annual inflation, $10,000 left in cash for 30 years would still show $10,000 in your account. But its purchasing power would fall to only about $4,100. The same $10,000 invested with returns similar to the long-term historical performance of the S&P 500 would grow to roughly $71,900 after inflation. That's the power of compounding. Over 30 years, the invested money grows more than 16 times as much as the cash. Unfortunately, many people never experience that growth because they're waiting for the perfect time to invest. I'll wait until after the next crash. I'll wait until the market feels safer. I'll invest when everything becomes more certain. The problem is, history shows that waiting often comes with a hidden cost. According to research cited in the report, investors who stayed fully invested over a 30-year period earned about 8.45% annually. But missing just the market's 10 best days reduced that annual return to only 5.56%. Just 10 trading days. Over 3 decades, changed the outcome dramatically, and here's the surprising part. Those best days often arrive shortly after the market's worst days, which means the investors waiting safely on the sidelines are often the very ones who miss the recovery. And history has repeated that lesson through nearly every major financial crisis. Let's look at what actually happened. History never rewards the people who wait. If holding cash during every crisis was the best strategy, history should be full of people who became wealthy by waiting. But that's not what history shows. Again and again, the pattern has been remarkably consistent. Markets fall, fear takes over, people rush to cash, then the recovery begins. While many of those same investors are still waiting for the right time, let's look at what actually happened. The dot-com crash between 2000 and 2002 wiped out enormous amounts of wealth. The Nasdaq lost nearly 78% of its value, while the S&P 500 fell roughly 50% from its peak. For many investors, moving to cash felt like the safest decision. But from 2003 to 2007, the S&P 500 nearly doubled. Those who stayed on the sidelines didn't just avoid the crash. They also missed one of the strongest recoveries that followed it. Then came the 2008 financial crisis. Banks failed. Housing prices collapsed. The S&P 500 once again lost about half of its value. Millions of investors abandoned the market, believing the worst was still ahead. Instead, after reaching its bottom in March 2009, the market began an extraordinary recovery. By the end of 2009, the S&P had risen more than 60% from its lowest point. Those who waited for complete certainty often returned years later, after much of the recovery had already happened. The same story unfolded during the COVID crash. In just a few weeks during early 2020, the S&P 500 dropped about 34%. Fear spread across the world. Once again, many investors chose cash over uncertainty, but the market recovered far faster than most expected. By November 2020, U.S. stocks had already regained their pre-crash highs. The investors waiting for the perfect moment discovered something frustrating. The market had already moved without them. Even the 2022 bear market followed a familiar pattern. The S&P 500 fell roughly 25% from its January peak. Many believed another major collapse was inevitable. Instead, inflation began easing. The pace of interest rate increases slowed, and by 2023 and 2024, the market reached new all-time highs. Those who waited for one final crash ended up watching another recovery from the sidelines. Different decades, different crises, different headlines, yet the same outcome. The research reaches a simple conclusion. Markets have repeatedly recovered from major downturns, while investors who remained in cash often missed the rebounds that followed. So if history keeps teaching the same lesson, why do some of the world's most successful investors still hold cash? The answer is because they don't use cash to build wealth. They use cash to protect flexibility. The people who build wealth don't think like most people. By now, one thing should be clear. The goal isn't to eliminate cash. The goal is to understand what cash is actually for. And that's exactly how some of the world's most successful investors think about it. The research shows that legendary investors don't treat cash as a long-term investment. They treat it as a tool. Warren Buffett has often compared cash to oxygen. When you don't need it, you hardly notice it. But when you do, it's essential. Cash gives you flexibility. It gives you peace of mind. And most importantly, it allows you to act when everyone else is forced to panic. As Buffett put it, cash combined with courage in a crisis is priceless. Charlie Munger shared a similar philosophy. He believed patience is one of an investor's greatest advantages. Sometimes the best decision isn't rushing into the market. It's waiting for exceptional opportunities. But waiting for an opportunity is very different from avoiding investing altogether. The same idea appears in Seth Klarman's approach. He describes cash as an opportunity fund, not money that sits idle forever, but capital that's ready to be deployed when outstanding opportunities appear. And this mindset isn't unique to famous investors. According to the research, wealthy portfolios typically keep only a small portion of their wealth in cash and bonds. The majority is invested in productive assets such as stocks, businesses, and real estate, because they understand a simple principle. Cash preserves options. Assets create wealth. John Bogle captured this idea with a phrase that has become one of the most repeated lessons in investing: time in the market beats timing the market. Rather than trying to predict every crash, election, or interest rate decision, successful investors focus on staying invested long enough for compounding to do its work. In the end, the difference isn't that wealthy people never hold cash. It's that they never expect cash to do a job it was never designed to do. They use it for security, for emergencies, and for opportunities, but they rely on productive assets to build lasting wealth. And that's the lesson history has been teaching for nearly a century. The biggest lesson. So, what's the real lesson behind everything we've seen? It's not that cash is your enemy. It's that cash was never meant to be your wealth-building strategy. The research reaches the same conclusion again and again. Cash has an important role. It provides liquidity, it covers emergencies, it gives you flexibility. But it's only one part of a financial plan, not the entire plan. That's why financial experts recommend keeping enough cash for short-term needs and emergencies, typically around 3 to 6 months of essential expenses, and in some cases more, such as for retirees. That reserve protects you from being forced to sell investments during difficult markets. Everything beyond that has a choice to make. It can sit still, or it can go to work. History strongly favors the second option. From 1928 through 2024, broad U.S. stocks delivered an average annual return of about 9.94%, while Treasury bills, representing cash, returned only about 3.31%. After accounting for inflation, cash barely preserved purchasing power, while productive assets generated substantial, long-term real wealth. That's why the biggest risk isn't always market volatility. Sometimes, the biggest risk is believing you're completely safe, while inflation quietly erodes your purchasing power and time silently steals your opportunity to compound. Because the market can recover from crashes, but it can't give you back the years your money spent doing nothing. So the next time you check your bank balance, don't just ask, "How much money do I have?" Ask yourself something far more important. How much of my money is actually working for me? Because real wealth isn't built by watching a number stay the same. It's built by allowing productive assets to grow over time, while cash quietly does the job it was always meant to do. If you enjoyed this documentary, don't forget to like the video and subscribe to the channel for more deep dives into investing, economics, and the financial decisions that shape your future. Thanks for watching, and I'll see you in the next one.